Okay, so that was Bill Gates jumping around because he was happy that Windows 1995 launched. And I hope you'll feel exactly this amount of happiness yourselves. He was at the end of a very long and hard project. And you can see here that we have come to the last chapter that we will study together. It's chapter 12. Now, you might say to yourself, well, so far we've done chapter 1, 2, 3, we skipped 4, and then we went all the way to 9. But chapter 12, it kind of seems out of place. It is out of place. In fact, I'll share with you that actually most classes, most Fin 3, 10 classes do not have chapter 12, but I put it in there. That's how important I think it is. In fact, if you take 3.3.11, I think it's so important, if you take it with me, that you'll get to cover this chapter a second time. That's how important I think this chapter is. This is the most important chapter in the textbook. Maybe for almost all of you, the most important chapter that you'll study in a finance course where you can actually apply this to your personal life. And I actually encourage you to apply it to your personal life. I don't think that, oh, go ahead. I don't think that, a lot of these concepts we learn are so useful if you never ever use them. I know there are some people in this class that come from different majors and maybe they never return to finance. And then, of course, there are also people that do study finance that never actually apply the concepts to their real life. And, if you go home over a holiday and your parents say, well, I took all of these classes, or you took all these classes, your parent, paid for them. What in the world should I buy in the stock market? I gotta make money back on my investment. You, the student, are my investment. What did you learn in finance class? And unfortunately, what happens is a lot of people go through an undergraduate major in finance, and sometimes even a graduate degree in finance, and then they end up learning their investment lessons from a YouTuber. Okay, nothing wrong with that. I mean, I think that people on the internet have some valuable insights. But I also wanted to kind of teach it myself so that you could get some of my perspective, because that's actually how my journey into finance started. I was a lawyer, or at the time I was a law student, and I had some money saved up after college, and I had about $25,000. I remember that, and so I just thought to myself, this is theoretically a good bit of money. And by the way, my parents didn't give it to me. I saved this up by, working from the age of 16 and so forth. And I thought to myself, geez, I worked pretty hard for this money and it's just sitting there. Now, it's not really enough to buy anything except maybe a stock or maybe a bond. And I thought, it doesn't make sense in the bank account. It's making like 0.01%. Not even joking, 0.01% in Wells Fargo. That's where I had my account. And I thought to myself, that's not a lot of money. And I want more return. And I've heard of these mythical things called stocks and bonds, and they're supposed to make you money. But then again, it was around the year 2012, so a lot of people had just lost their money in stocks. Gee, what in the world should... So my own personal journey into finance didn't come from me taking a major in finance. My major was mathematics. But I started to trade a lot on the market. I wasn't very good, but I traded a lot. And I bought a bunch of stocks, sold a bunch of stocks. Some of them were common stocks, which we talked about. Some of them were preferred stocks. Some of them made money. Most of them lost money. So I got smarter with time. And I found some useful books that I think are very, very useful that I can recommend to you. But what those books talked about, and where they were particularly useful, is that historical performance can sometimes inform us about what is likely to happen in the future. Now, if ever you go to an investment company, they will tell you the past performance is no indication of future results. But actually, the way we try to predict future results frequently is by modeling past performance. When we stress test our stocks, what do? Well, we look at what happened, during the tech crash in 1999 or the financial crisis in 2007 and 2008. How do we estimate how much our investments are going to yield? Right? I mean, there are people that run pension funds and retirement funds, and some people that save and invest for their retirement. how do they really predict what they expect to have 20, 30 years from now? They really have to use historical returns. And that's why the history of the market, which by the way was my other major in college, is actually really, really important. So today we're going to combine some very, very basic mathematics with some very, very basic history. And hopefully then when you go home and talk to your parents or your relatives, and they ask you, well, what might be a good investment? At the very least, what you could tell them is, well, it sort of depends on your risk preference, but here's an investment that yields this much, here's an investment that yields this much, and here's on average what you can expect. Now, I hope you ask me questions. This is sort of a lecture again that I teach not just from the market experience, but from my own experience. And I really enjoy talking about the stock market. I mean, I like to think I'm pretty active. I certainly made several trades this year, and I'm thinking of making 2 or 3 trades more here in December, as is tradition. As you know, trades have tax implications. So a lot of people make certain trades in December to either take out capital gains or cash in capital losses, depending on what's most beneficial for their tax bracket. So I think this is a tremendously fascinating chapter to study. And the stock market itself, to me, is still a very, very fascinating source of wealth in the United States. And it can be for people that invest into it from abroad. Now, what we'll talk about today are the returns on the investments in the stock market, and specifically the historical returns. We'll talk about how to measure the return, and we will talk about what those measures look like for the stock market over the past 100 years. And that's a pretty good chunk of history. Okay, very few people are alive that have lived more than 100 years. So that means that in living memory, okay, the stock market has performed in what I would argue is a pretty consistent way that is why a lot of people that make their money one way or another do so through financial instruments. Okay. And so in the United States, I think I mentioned a lot of people end up being, millionaires, right? 10% or more of all Americans are millionaires. And it's very, very hard to get there unless you invest or unless your family members invest and then you inherit that wealth after they pass away. Now, that's how a lot of people become millionaires. I mean, don't be in a hurry. Most people that are millionaires are in their 50s, 60s, and 70s. It's like, yeah, it's 10% of Americans, but it's probably less than 1% of all people in their 20s and 30s. And it's probably, very, very concentrated on people that are older, due in part to the fact that they're able to inherit their family's wealth. But that wealth frequently comprises investments. And I think I'll argue to you persuasively that it's an excellent way to boost your personal income, the income of whoever it is, whoever's money you're managing, and so on. So we'll look at the returns and their historical record. And then that's sort of the first part of this chapter. And then I'll talk about how we actually calculate those returns and why those numbers are important. Like we're going to talk about volatility and the standard deviation of returns. We'll also talk about how to take averages. The last time I kind of talked about the stock market, I said, the S&P 500 returns about 10%. What does that mean? Is it with dividends? Is it counting inflation? What kind of an average is it? Is it an arithmetic average? Or is it a geometric average? Those two numbers are not the same. Geometric average is usually lower. What happens when you account for these? Well, you get different numbers. And it's important to understand what those numbers are because, hey, if you're going to plan ahead and you want to consider yourself to be wealthy in the future, you need to understand the growth rate of your portfolio, which if you recall that financial calculation spreadsheet that we use, you needed to have a growth rate. And the assumption initially was about 10%. We're going to talk about how we get to that number, and then also how much deviation from that number you should expect if you're unlucky or if you are lucky, right? Because it's like, we talk about volatility in terms of risk, meaning the difference, in price from the average that we observe. But, it can be to the downside, but it can also be to the upside. Some years the S&P 500 returns negative 10%. Some years it returns 40%, positive 40%. That's a pretty big gain. And, you want to try to account for that when you think about it statistically. So we're going to talk mostly about American financial markets. And I actually think that American financial markets may be the best thing about America. Now, that's a pretty strong statement, right? But I think it may be the thing that America does best. So I used to go to attend a political club back at my university just for fun. I mean, I was a graduate student there. Most students were undergraduates, and they were your age. And I like to stir up trouble, so why not? I'll show up. I like to debate and I like to argue. And it was sort of a political club. And the club used to have like a motto, and it was like USA is number one. Like they were like really patriotic. And I would always show up. Of course, I'm Russian originally, but I'm an American citizen. But I guess I have some international perspectives, right? And so I would show up and I would say, well, what is your empirical evidence for that? I mean, you claim that America is number one. Well, you guys are all about evidence, right? What's your proof? And you know what? In 2 years of going to that club, not a single person was able to cite a single statistic that proved that. But you know what? They still religiously believe. They're like, America is number one. It's like, well, how do you measure that? They're like, well, I would say to them, like, well, we're not number one in education. All right, our students are not very bright. I mean, we've tested them. Students in Singapore, China, India, they're all outperforming the American. Europe, everybody is outperforming American kids. Can't be education. What about longevity? And they would say, I'd say, well, longevity in the United States, like how long you live. We live shorter in America than we live in China, in England, in Ireland, in Germany. Everybody in Japan, everybody lives longer than Americans. They'd say, well, altogether, if you add all of these things up, we're the best. I'm like, how are you going to do that? How are you going to add longevity to the national debt? Do you just plus it? Are you going to weight it? What are your weights on those variables? Right? Well, we have the number one GDP. It's true. What about the PPP? No, we don't have that. PPP is income or your purchasing power adjusts the GDP. No, China is actually the number one nation in purchasing power parity, PPP. So what what else, right? Well, the United States is number one in a few things, like they're number one in crime. There are more crimes committed in the United States than there are in any other country. And there are more people in prison in the United States than there are in any other. They would always tell me, well, they would tell me we're number one at liberty. I'm like, well, depends on how you measure it. Do you measure how many people are in prison? Because if you measure it like that, we are the worst at liberty because we have the highest prison population in the whole world, not adjusted by population, just period. Like in the whole world, we have more people in prison than India and China combined. So how do you argue for that? So it wasn't fair. I was a graduate student. I had a bunch of graduate degrees. I'd already been to law school, and here were these undergraduates, and I was asking them this question. But they never asked me the question. Now, I wouldn't make the argument that the United States is the greatest country in the world. I don't know how anybody would prove that in any legitimate way. But I will make one argument. I think the American stock market is the best stock market in the world. And I'm going to argue that to you persuasively. The United States stock market is one of the oldest stock markets, if not the oldest. It kind of depends on where you trace back the beginning of the stock companies back in the 1600s. I'm sure the British sort of predate the New York Stock Exchange by some decades. I'd have to look. But the United States stock market is the biggest. It has a very, very consistent growth rate, one could say, compared to some of the other markets, in that growth rate is generally speaking positive, right? So there are some markets today, there are all sorts of stock markets today. And if you watch the performance of those indexes, they do rise, but they frequently fall. So you're not guaranteed that if you start, let's say in 1990 and invest some money, that in 2020, that pile of money has grown. It's possible that it even has shrunk. But if you did that in the American stock market, it is virtually guaranteed historically. There's never been a 30-year stretch where you did not make money. Okay. So that's pretty significant. Like, hey, wait a minute. That's like free money, right? Well, not exactly. Okay. the United States stock market is pretty great because of how complete it is, right? There are a lot of firms there, a lot of industry sectors are there. There are all sorts of trades that are possible on the American stock market. You can take a long position in a stock, meaning to purchase it, or you can purchase some options that allow you the right to purchase that stock. You can also take short positions. There are a lot of stock markets, stock exchanges where they don't let you trade short. Okay, so what that means, by the way, is that you sell shares you don't actually own. Okay, you borrow the shares from somebody and then you sell them. And when the price of the share sinks, you buy them at an even lower price and return them to their original owner, right? Some markets don't allow for that because, well, there are many political reasons, but it's possible that your losses could be infinite, right? I mean, imagine if you shorted Apple, back in 1980 or something, probably, your position was closed because your account went bankrupt. If you still kept that position open. So the United States market allows for tremendous freedom when it comes to that kind of trading. It allows for tremendous options in terms of what firms you buy. All sorts of firms that do business everywhere internationally still list within the United States. That's what's so remarkable, is that you can have a company where its primary business and its primary profits are international, but they will still list in the United States, due in part to some of the corporate protections that American law theoretically offers the shareholders, and perhaps also because there's, let us say, a potential prestige factor, right? If you're traded on the New York Stock Exchange, once you start trading there, or you start trading on the NASDAQ, people think that's a big deal, okay? And it is an indicator than if you trade on some other unknown exchange, let us say. So the American stock market is pretty good, but the good news is that, through a variety of vehicles, people can invest in it, and a lot of people make a tremendous amount of money. Part of the reason is that, again, the stock market, if you just, let's say, just buy the market in general, like buy the S&P 500, you don't even have to be that good. The market just makes money by itself, so you don't necessarily have to pick the right stock at the right price. There's good research that shows that you can try to time the S&P 500, but generally speaking, people are not even good at doing that either. So a lot of people, including Warren Buffett, have said that unless you're like a very sophisticated trader, you can basically close your eyes and just invest a portion of your paycheck every month in the S&P 500, and you'll wind up a lot better than if you had kept it in the bank, or if you had tried to time the S&P 500. Part of the reason for that is because the S&P 500 moves very little in the average day, but tends to have like really, really good days. And if you miss those days, if you're not in the market at that time, well, then you're going to miss out on a lot of the gains. So let's talk about how we can try to measure some of the gains. Okay, so these measures are important because we want to know how much money we're actually making. Remember that pile of money I told you about that I had in college? I'm like, well, darn, you're telling me I'm going to buy a stock. How am I going to make money from that stock? I don't know for sure that the price will go up. So my actual first attempt at being a good stock trader was to buy stocks that paid high dividends. I can tell you why there's problems with this if you want me to, but it's not enough to buy a stock that just paid a high dividend, right? Because what does it mean to have a high dividend? Does it mean it's a high percentage or just the absolute term? I think I'm going to argue to you that the best way to think about it is in terms of percentages. But let's look at this problem. We'll return to it. So total dollar return, that's not percentage, okay? That's the nominal dollar return. We're going to take the income from the investment, okay? For bonds, these are coupon payments. For stocks, these are dividend payments. And then we're going to take a look at the change in the price of that investment. When you add those together, you get the total return. So if you have a bond that's worth $950 and it has two coupon payments of $30 to you, okay? And then you sell the bond at $975. What is your total dollar return? Well, it's just addition, subtraction here, right? You got two 30-year coupons, so that's $60. And then $975 is greater than $950. It's exactly $25 greater. So that's a gain of $85. But you really want the percentage return, right? Because I don't know if this seems an impressive gain to you or not, but if it takes you a commitment of $950 to make $85, right? That's like a different investment than if it took you $10,000 to make $85, right? The reason for that is simple, right? Remember me when I was young, right? Only $25,000 in the bank account. So I can't take investments. First, like, why would I take an investment that was yielding so little? Okay. But second of all, there are some investments that are just unaffordable. So if you told me, okay, look, you have $25,000. If you give me this $25,000 for a year, I'll give you $85 back. That's not worth anything to me. Like, that's not a lot of money. That's not the kind of gain I want. What I want to do instead is to come over here and buy a bunch of those bonds, invest the full $25,000 into bonds like that, and make $85 per bond per year. That wouldn't be too bad, right? So that's why the percents matter, because if you don't calculate the percent, well, you need to know how much money is necessary to make that gain, and the percent calculation has that in it inherently. So all we do here is we calculate the dividend yield and the capital gains yield, and they are exactly what you would suspect them to be, because all we really need to do is change these numbers, right? The income and the capital gain. We need to scale them by the size of our investment. And that just means dividing by whatever the beginning price was. Okay. The value change of currency into consideration? You could. So if you were trying to measure your gains in RMB, but you were purchasing this stock in dollars, right? And you're saying, okay, in the future, right, there's going to be a change in the valuation of the dollar to the RMB. And let's say you knew that change. You could absolutely incorporate that into this equation. But that would be a more complex model, because now, you see, to calculate this, you're making, you're looking at ending price and beginning price, which theoretically you have access to, and the beginning price here. Okay. So if you were to calculate these things with currencies, right, you would also have to have the conversion rates at the time of the ending price and at the time of the beginning price. And then, of course, again, at the time of the beginning price. And so then you could adjust for the currency, for the change in currency value. And that's, of course, assuming that you're not projecting into the future. If you're projecting into the future, you'd have to sort of have guesses, reasonable guesses, hypotheses about how currency value is going to change. But yeah, I mean, good question for sure. You can adjust that. You can adjust for it for sure. But we're going to kind of assume we're in dollars here, although we can switch back to RMB if necessary. So total percent is going to be the dividend yield plus the capital gains yield. And makes sense, right? Those are the only two ways this asset can make you money. So you add its money-making potential together, and you sort of you get the total yield. All right. So here's an example. You bought a stock for $35, a dividend of $125, and the stock now sells for $40. So dollar return, well, that's just your dividend of $1.25 plus the change in the value of the stock. Okay, it was $35. It's now 40. 40 minus 35 is $5. That's how much it went up. So it's $6.25. Now, to calculate your percentage return, remember, you're going to scale it down by the price of the asset at the beginning. So you can just go ahead and divide 6.25 by $35, and you'd have your answer. Or you can do it separately. You can look at your dividend yield and divide it by 35, and then you'd have a 3.57% as your answer for the dividend yield portion. Then the capital gains, okay, the $5 over the 35, okay, so 14.29%. And then finally, you're going to have the total percent, which is 3.57 plus 14.29. Hopefully, you can convince yourself that this is the same as dividing 6.25 by 35. Yes. What's with the percent mark? Oh, you're saying it's missing the percent mark, like right here? Okay, you want me, does this make you feel better? Okay, all right, well, anything that helps you guys. I mean, really, by that standard, right? Shouldn't this, no, I guess everything else is fine. So yeah, okay, all right, I'll add the percent marks. You want me to save it? Saved. Now, all future classes, you fix the error for them. So now all the people, this is just as good as an evaluation. Excellent. So now all the future students will have those percents there. That's good. Good eye. All right. So the reason the financial markets are important, of course, is everything we've been discussing up to this point. So they're important because, people have savings and corporations have savings. There are piles of money that people have. And just like me, when I was 21, which is about when I started trading, I was like, I got this pile of money. What do I do with it? I don't need it right now. I would like it to make more money. And so the financial markets, and that's why they're so important, they allow that unused money to go to use. They go to some business in order to like improve that. They can, that business can now use that money to purchase machinery, et cetera, et cetera, et cetera, et cetera. That's not exactly what happens when you and I buy stock on the secondary market, because that stock has already been issued and somebody has already paid that money into the business. But it's still important that you and I go onto the market and buy that stock, because the ability to resell the stock is important, right? The person that's purchasing the stock originally and giving the company that money relies on the ability to turn around and quickly resell it, right? Because the liquidity that the financial markets provide are also very important. So, you might have invested in a company, right? But your investment horizon is 10 years. It might take 30 years for the company to really take off. You rely on the existence of a financial market so that after your 10 years, the company got 10 years closer to its goal, the value of the stock hopefully increased, but you can't wait the remaining 30 years. So you hope there's a complete and full and robust financial market that you can go to, and you can sell it to somebody else so that person can hold on for the remainder of the time. It's valuable that you were there for the first 10 years, but it's also valuable that another person can take over for you, right? That's how investments that can cash in many, many, many years after someone is dead can still be valuable, because that person can pass them on either via inheritance, but it's almost impossible to always do it via inheritance, which is why those financial markets are so critical. They're critical to the American economy, and they're critical to the thriving of the businesses that ultimately incorporate themselves in the United States and list on American exchanges. So this chart is the most important chart we're going to look at all class. It's so important that, again, if you take Fin 3311 with me, you'll study chapter 12 again, and we'll look at this chart a second time. Let me try to make it as big as I possibly can. Here. Is this better? Okay. There it is. All right. Wonderful chart. So what this chart shows you is the performance of various asset classes on American stock markets, or other markets, bond markets, et cetera. So what you see initially, so the very lowest line there, it's kind of purple, is inflation. And you can see that this graph ends in 2016. So we don't actually get the inflationary period that we've had starting with COVID up until now. But you can see that inflation erodes the value of the dollar. So if you just have a dollar and you just hold it, just that, right? You just hold that piece of paper. It's no longer as valuable today as it would have been in 1925. Okay, not surprising. We understand that inflation is occurring, and that different years there are different paces of inflation, but it's pretty smooth. Next, you see Treasury bills, which are very, very short-term investments in debt, in federal debt. So these are like 30-day increments. You buy a Treasury bill, you can hold it for 30 days, and then in 30 days, the government will want to borrow from you again, so you can buy the Treasury bill one more time. Okay, so you can just keep on doing that, and if you keep on doing that, the government, unfortunately or fortunately, depending on your perspective, has an insatiable attitude and insatiable appetite for debt. If you do that, you know, your dollar will grow, and it'll grow faster than inflation. But we have like the equivalent of 20 bucks today. Now, still, somebody who, you know, got that money when they were just born, or maybe when they were 10 and they lived to 100. Okay, so now at 100 years, they have 20 times what they started with. That sounds impressive. But when you compare it to other returns, it's not so impressive. Now, above it, you see the blue line. So these are long-term government bonds, like the 2-year note, the 5-year note, the 10-year note. So these, when you look at them, I want you to notice something, okay? So right here, it looks like they're pretty close to one another, right? But if you look over on this axis, it's not an axis that increases by the same increment. So it's not like plus $1, plus $1, plus $1. Okay, we start with 0, then these are little cent marks, then we get 1, okay, then we get 10, then we get 100, then we get 1,000, then we get 10,000. Now, the reason that's important is you see that that's increasing exponentially, right? 10 to the power of 0, 10 to the power of 1, 10 to the power of 2, and so on. So actually, if you were to graph these on something that increased by 1 or 2 or 3 or so forth, the gain on the blue line would be off the charts compared to the gain of the other two lines. So government bonds, you do a lot better. If you just bought government bonds, thanks a lot, I'm sure, to the 1980s, where you see this little pivot, right? It used to be kind of the same as T-bills and inflation, but there's a pivot in the 80s, and it really takes off, right? Yes, sir? Oh, you can't see the mouse clicker. Oh, look at the pivot. Right here. You see this pivot? It's all about the same as inflation and T-bills until this pivot in the 1980s. Okay, when Paul Volcker and Ronald Reagan, but Paul Volcker mostly, he's the only one that theoretically can raise these rates. He raised the Fed rates. And so the Treasury bonds started to issue at like 10%, 15%, right? What I wouldn't do to get a hold of one of those 15% bonds. Although inflation might get so bad here in recent years, I might have another chance. I don't know if I'll want it then, but yeah, so you see I have this pivot and this increase in returns. So that's pretty good. $133 for $1 back then, that's a pretty good increase in investment. So if you put $10,000, right, you'd have more than $1 million. Yes, sir. Yeah, well, it takes 90 years, but it's a very safe investment, right? Now, you might, again, I realize the first 3 are boring, but the next 2 are exciting. Look at what you get with stocks. I mean, if you look at this orange line, right, these are just the large company stocks, which are theoretically a little less risky and less volatile. For every dollar you invest, you end up with $6,000. $6,000. That's like a lot, guys. That's really, really good. I mean, if you invested $1,000 in this, right, you have $6 million. Now you're like, well, 90 don't. It's like you'd be like, oh well, that was only 90 years later, right? That would be, and that's a fine reaction. But I would say to you, okay, well, you hit $6,000 or $6 million, you know, 90 years later, but 60 years, you know, later, you hit $1 million for just $1,000. I mean, that's all you put in. That's pretty good. But you might say to me, I am unsatisfied with that. That's not good enough. I'd say to you, you know what? There's one more line you should look at. Small caps. $33,000 for every dollar that you invested in 1925. That's huge. And keep in mind, that's including the Great Depression. That's including the Great Recession. That's including the COVID bear market. That's including the bear market we were in just now that we might still be in. You'd still make $33,000 for every dollar with all the downturns. Now, yes, you're going to have a tough year in the middle of the Great Depression, right, where you actually ended up with about 40% of what you started with. But after that, those stocks are up and running. So, but go ahead.
20 years maybe small company become large.
Yeah, that's entirely true. So in that situation, right, the assumption is that you keep finding good small company investments. So the idea here, though, is that this is sort of an averaging. Okay. So when an averaging occurs, it's not that you picked one small company and stuck with it forever. The assumption in this chart is sort of the assumption that you buy a broad index fund of these companies, okay, or an exchange traded fund as they're known. So the idea is that this isn't any one single company, because if it was one single company, Apple would be up here completely off the chart. Like we have to, Apple might have to jump, in order to tell you where it ended up. Okay, the same with Microsoft, but same with some of these companies. On the other hand, if it was some individual companies, plenty of them ended up at zero. So that's why a lot of people don't select just one stock. So when I first started investing and initially lost a bunch of money, I mean, not that much. I think my worst loss is like $2,000 on an investment of like 7,000. So that's actually a pretty big portfolio downward move. But what was happening is I would hold stocks and, some of them would go up, but some of them, of course, would not. And some of them went to zero. So there are a few stocks I sort of thought to myself, young and foolish though I was, I said, well, look, this stock is a bargain. It's only $3 a share. Why wouldn't I buy this stock? It can't go any lower. Yes, it can, guys. I can probably, if anybody ever tells you you should buy this stock because it can't go any lower, I can guarantee you it can go lower. Yeah. I ended up with a couple of shares that ended up on a different exchange. So they were trading on the NASDAQ, and then they lost so much value that the NASDAQ was like, you have to get off we're not going to trade you anymore. And they ended up on some other weird exchange. I was like, this is the penny stock exchange. So yeah, you don't want to end up with a penny stock, but I ended up with a couple of them. But what I started to do and what I realized relatively quickly after reading a couple of books is that you actually, if you want to eliminate the risk of a single stock taking you down, what you can consider doing is purchasing a large basket of stocks, usually packaged together in an exchange traded fund. And then with that large basket, even if one goes down, that's okay, because the rest of them didn't go down. And the one that goes down, that ETF gets rid of and then just replaces it with whatever's coming up next, if that makes sense. So for example, when they are looking at large company stocks, I don't know what index they used, but they could have used the Dow Jones Index, which is an index of the top 30 stocks in the United States. I mean, theoretically, the top 30 stocks, right? A committee sort of picks these stocks. But every time you watch, CNBC or you go to marketwatch.com, the Dow Jones Index is up at the top because it's both an indicator of the performance of the overall stock market, not as good as the S&P 500, but we'll get to that in a minute. But it's an indicator of how the market is doing, and it's a quasi-diversified index. Okay, the idea being is that it contains several firms that, number one, are different from one another. So if one of them tanks, right, the other ones might go up to offset that loss. But also, you might have a situation where an entire industry tanks, right? Like at one point, there was no longer a need for typewriters, right? Or you just think of all the things that we no longer need because we have technological replacements today. And so at a certain point, you never know when a sector is going to go down, is going to go lower. So if you're diversified, not just across stocks, but across business ventures, like this company is in utilities, this company is in electronics, this company is in vehicles, right? If you diversify across sectors, then you will be less exposed to the risk that is associated with a particular sector, okay? And so buying a broad ETF across many industries allows you to do that. Now, that's diversification, and that's the concept of diversification. And a lot of investors sort of adopt this concept. And if you go online, you'll see you need to diversify your portfolio. Just understand this, diversification is only useful if you are risk averse. Okay, so in theory, at least in most models, right? It's the risk aversion, the negative utility you get from price volatility that makes diversification optimal, because at least you can diversify away the non-systemic risk, the firm-specific risk and the industry-specific risk. You can get rid of it. Like you get diversification for free, as they say. But just understand this, that if you diversify, so let's say you can pick a really good stock, right? And you can just buy shares of that stock. Like, let's say you picked Apple. Okay, if you diversify from Apple, that means instead of taking your whole $25,000 and putting in Apple, you're gonna put 1,000 in Apple, 1,000 in Microsoft, 1,000 in Blockbuster, 1,000 something else, right? But the problem is that the Blockbuster bet is going to be bad. So the overall return of your portfolio would actually have been better with one stock, Apple, than it would have been with Apple and Blockbuster, because Blockbuster went bankrupt, for those of you who don't know. So when you diversify your risk, just understand you also dilute the return of your good stock picks. The reason that you diversify, though, is because, as I learned when I was young, is that you can't always pick the good stocks. I've picked plenty of losers myself, right? So it's very possible you do all the research, you read about the stock, you look at the fundamentals, and you can still be wrong. And that is why most people suggest diversification. Because where with me, I lost a few $1,000s, you just can't trade like that if you're 50 years old and you've got kids and you can't come back home to your family and say, look, I lost all the money in the stock market today. All the money I worked 30 years to save for, I lost all of it. Like, you just can't do that. And that's why a lot of people diversify, right? And so that seems to be the standard advice of most investment professionals. All right, so let me pause it here. Let's see how I can exit this thing. All right, and I'm going to give you guys time for the student evaluations as promised. So again, fill them out. I hope that all of you fill them out. I'm going to give you 30 minutes. You don't have to take the whole time. I'm just going to exit the room and go up to my office. I won't be back. So just whenever you're finished with the evaluations, feel free to go about your day. So yes, and again, I hope you fill them out, but I believe in liberty. I believe in freedom. So you don't have to if you don't want to. All right, guys, I will see you guys on Monday.